want to first welcome everyone to today's Multnomah Group webinar, Financial Markets Check-In Amid the Coronavirus Market Mayhem. We're going to go through what's been really an unprecedented period of time from an economic, market, and obviously global health perspective. Before we get started, I want to obviously wish everyone good health. It's extraordinary times, and we appreciate the small portion of your day to talk about what's happening in the financial markets marketplace. I did want to start with a couple of housekeeping items before we get into today's presentation. First of which is that we're recording today's presentation, so you're all on mute. That said, we would welcome any questions that you might have over the course of our short presentation today. If you have any questions or comments, feel free to utilize the Q&A taskbar in the application, and we'll try and cover those over the course of today's presentation. At the conclusion of today's presentation, we'll be distributing a copy of the recorded presentation along with today's materials. So you'll be able to receive that, go back and view it, share it with others to the extent that you feel a need to do so. So with that, I'll go ahead and get started. In today's presentation, we'll have three members of the Multnomah Group's investment committee. My name is Eric Daly. I'm a consultant and principal with the firm. I'm joined with Scott Cameron, who is the chair of our investment committee and chief investment officer, and then David Williams, who is another member of the investment committee and another senior consultant within the firm. We're going to break down today's presentation really into three chunks. I'm going to start and talk a little bit about what's happening from an economic perspective and what we're experiencing there. I'll hand it off to Scott to talk a little bit about the activity of the Fed and the impact on interest rates based on what's happening in the marketplace. And then David will close us out with a review of the equity marketplace and what we're experiencing on that side of the world. You know, I think as we've entered the pandemic and the pandemic has begun to spread here in the United States, and we've moved to a shelter-in-place footing across much of the country, and certainly a safe social distancing across all the country. What has been most notable in historic terms is the impact of those policies on employment. And this is looking back over a 25-year history of what are referred to as weekly first unemployment claims. And you can look back at 2008, 2009, and the increase in general weekly unemployment claims during the financial crisis. But what is unprecedented over the course of the last 3 weeks is the magnitude and rate at which things are moving. And again, the country has had various recessions, certainly, and external impacts to the economy. What has been most unique, at least from my perspective, of the COVID-19 virus and its impact on the economy is the rate at which it has impacted the marketplace from an employment perspective and certainly from a consumer perspective. And those two things tend to be integrated pretty heavily. Just to give you a sense of magnitude, I wanted to show you a shorter period of time so you could get a sense of what unemployment claims have looked like over the course of 3 of the last 4 weeks. We don't have this Friday's unemployment new claims number, although I would expect it to be relatively similar to what we've experienced over the course of the last 3 weeks. So you can see back 3 weeks ago in March, almost 3.5 million new claims. Over the course of the last week of March, first week of April, new claims in excess of 6 million in each of those weeks. And again, by order of magnitude, 4, 5, 6 times more new unemployment claims than any other point in recorded history. And I think that trend is likely to continue. I think while this is the initial unemployment claims, there are a number of employers who have guaranteed employment to their staff through the end of April. Other organizations that have done so through the end of May, and in some cases others that have done it through the end of June. But ultimately, if we don't have an increase ultimately on the demand side, you would expect that the unemployment numbers would continue to elevate, maybe not at quite the same rate, but certainly at a very significant rate given the historic pattern of weekly unemployment claims. You know, I do think having lived through the 2008-2009 financial markets crisis, that we do have much more perspective on how to address decreases in demand and shocks on the economy. If you look back over the 2008, 2009, there were a number of different countries that adopted different models to addressing the decline in demand that was driven by the 2008, 2009 financial crisis. You had in the U.S. that took a much more active role. You had certainly some of the European countries that were slower to trying to generate some kind of demand or stimulus to demand within their various economies. And if anything, the lessons learned here in the United States seem to be that you act quickly and you act with great magnitude. And I think as a result, what we've seen over the course of the last several weeks is 3 bills through Congress, the most meaningful of which being the CARES Act, which was passed in late March, which was a very material bill aimed at trying to address the impact of unemployment and make sure that there was still money flowing through the system so that demand would not dry up entirely. So while referred to as a stimulus package, don't think of it as a stimulus the same way you would as far as trying to enhance growth, because at this point, I think there is very little hope of trying to enhance demand materially over the course of the next week, month or two, but instead to provide some social security net to those that may need it, make sure that there's cash flowing through the economy so that some businesses continue to operate in a way that's material. So the CARES Act, really a $2.5 trillion stimulus bill, was significantly larger than any that we've experienced historically. I think most people continue to refer to the 3 biggest components of it: the individual bill, which are the individual component of the bill, which are the direct stimulus checks that hopefully U.S. citizens will be receiving over the course of the next couple of weeks. You have the small business protection that came largely through the PPP, the Payroll Protection Program, and then various targeted big corporation type stimulus efforts to try and preserve areas like airlines, for instance, which obviously have been materially impacted with the almost immediate reduction in travel during the shelter in place and safe social distancing practices. Just to give you a sense from context perspective of what the CARES Act looks like, the $2.3 trillion is significantly more material than anything we did over the course of the 2008-2009 period relative to the financial market crisis. If you look at the $2.3 trillion in the CARES Act, that's roughly 75% of the entire 2019 tax revenue received by the United States over this period of time. And it is material in nature. About 1.4 trillion of that will go out in direct payments to either individuals or corporations. The other, 850 billion will be loans and guarantees. But again, acting quickly and acting significantly. Even over the negotiation of the CARES Act, you saw what was a $1 trillion bill get talked into a $1.5 trillion bill to a $2 trillion bill, and now roughly a $2.5 trillion bill. So very, very significant if you look at it in the context of other spending programs here in the United States. From a GDP perspective, it's intended to try and again create some form of counterbalance. So if you look at US GDP in 2019, what you'll see is that consumer personal consumption was roughly 2/3 of US GDP, and that's been the area that's been impacted most significantly from the pandemic perspective. If you look at government consumption is held in at roughly 20%, maybe a little less than that of GDP. Adding to this, the CARES Act stimulus will take that up to roughly 30%. The CARES Act ends up being a stimulative program with about a 10% GDP hit, which is going to be material because certainly personal consumption is likely to be off, at least for the next couple of quarters, significantly from what we experienced in 2019.
Eric, I would also mention, obviously the personal consumption piece is going to take a hit, but I think it's not unlikely that that's going to also flow into some of the business investment that you see in the second quarter into the third quarter, where with demand in decline and companies trying to right size, their expense profile relative to revenue, that they delay or cancel business investment, and that also having a negative impact on GDP for the next couple quarters.
Yeah, that's a great point. We work with a number of manufacturing organizations, and they've seen an almost immediate reduction in discretionary orders. So things that are in process may be completed, and if you're a manufacturer of products that take a long time horizon, those are still within the queue. But anything that's on a shorter duration has either been canceled or no new orders are coming in. And I do think that that impact is going to be there. On the CARES Act side, I think what's been talked about most significantly continues to be the direct payments. When will they arrive? How large will they be? Just to give you a sense of what those are going to look like, you know, a married filer with 2 children, combined income under $150,000 is going to be looking at roughly $3,500 in payments, and obviously scaling down from there. This is in addition to some of the extended unemployment benefits. So again, knowing that one of the primary concerns, I think, for the economy is the rate at which the unemployment numbers have increased, and the likelihood that that may continue for some period of time. These direct relief payments in combination with enhanced unemployment benefits in some hope to try and create a safety net until we can come through this particular pandemic and back to a stronger economic footing. You know, ultimately, this is the scary part. If you look at the 2/3 of the consumer spending being ultimately the GDP numbers, what we've seen is consumer spending stop almost immediately across the board. The only difference being groceries, right? So if you're looking for the toilet paper bump, ultimately that's the toilet paper bump of increased grocery spending as people have stocked pantries, understandably, in preparation for being sheltered in place for some period of time. But travel expenditures off 80% from a year prior, shopping on the decline, transportation, certainly entertainment and restaurants, health and beauty, and all of those continue to decline. I think we'll continue to see it through April 15th that those numbers have continued to cascade downward to, in some cases, near zero, frankly, as it relates to travel and transportation. So if you look at the U.S. consumer spending forecast that's prepared by the U.S. Bureau of Economic Analysis, the picture looks like really 2 quarters of very, very low decline consumer spending with a hope for a rebound in the mid-3rd quarter to 4th quarter of 2020. And some hope that maybe by the end of 2020 that spending rates will be back at a more normalized level. But the rate of decline, again, you're looking at a 25-year history of consumer spending. This is an unprecedented reduction, especially given the period of time that we're talking about. So maybe with that, Scott, I'll throw it over to you to talk a little bit about the Fed and what's happening on the interest rate and bond side.
Sure. So Eric mentioned, obviously when dealing with these types of situations, we have kind of 2 primary levers at play. We have the fiscal policy, which is really in Congress with the CARES Act and the bill there. And then we have monetary policy, which is the domain of the Fed. And what we've seen is similar to Eric's comments about kind of move quickly and move aggressively. In these situations, we've seen the Fed do that. So if we go back to early March, we saw the Fed cut rates and a couple weeks later cut rates again, so that we're targeting a Fed funds rate of about 0 to 0.25%. In this type of environment, though, a rate cut doesn't really have any kind of significant impact on supporting the economy. It's not that, when rates were at 2%, borrowing was too expensive for companies. It's really just, the fact that the demand side has dried up so significantly. So, the traditional tools that the Fed uses of moving interest rates to kind of stimulate or slow the market haven't been particularly effective. I think the bigger impact that they've had and came with that second rate cut was communicating to the market broadly that they are going to use the balance sheet that they have to provide liquidity. The bigger issue that we see in credit markets is that in periods of financial uncertainty like we have now and we had in 2008, 2009, things like counterparty risk change within many lenders. And so traditional normal functioning markets where credit is accessible, it's trading at normal spreads. All of those things dry up as people have uncertainty about their counterparties and whether, if they lend money out or they borrow, that market's going to continue to function. So what the Fed has done is stepped up and most recently announced a $2.3 trillion package of enhancements, or I guess activities designed to keep credit markets functioning normally. And many of the tools that they're using are ones that they used in the 2008-2009 financial crisis, and to a greater extent more expanded. So you can go back to quantitative easing, the idea that the Fed can buy US Treasuries, and then eventually they kind of trickled into mortgage debt. The Fed's doing that. They're buying Treasuries, they're buying mortgages. They've expanded that to buy investment grade credit, to buy high yield, to buy municipal bonds. They've expanded to lending, direct lending to small businesses and to larger corporations. They basically said, we're going to do whatever it takes to keep credit markets functioning to the best of our ability, so that this economic issue that's been impacting us doesn't expand beyond where it should to companies that are maybe otherwise healthy, but because of credit market freezes, can't get the normal access to capital that they've had. So, the Fed's actions have, again, similar to the CARES Act, have been very aggressive, have been significant in scale to a degree that we've never seen before. As we look at it, we don't think it's going to necessarily stimulate growth or GDP because borrowing is cheaper. There's a lot of money that's floating out there. It's really designed to keep credit markets from freezing up and compounding the issues that we're seeing on the demand side. Fixed income for the quarter, if we look at how that impacted the performance of bonds, the quarter numbers are a little odd because we had a couple months of just kind of normal, and then March. What we saw is with the rate cuts, interest rates declined, and so that actually helped support bond prices. If we look at the Barclays or the Bloomberg Barclays Aggregate Bond Index, kind of the broad benchmark that most fixed income managers use, it was up a little over 3%. That benchmark is heavily tilted and weighted towards treasuries, and you can see treasuries were the best performing sector of the fixed income market. So with the decline in interest rates, the flight to quality, what we expect to see, we saw normally, which was a push up in treasury prices. The sectors that struggled the most on a relative basis are those that you would expect to see as well in a liquidity credit crunch. Investment grade, emerging markets, and some international or high yield bonds, also underperformed. On the next page, if you look, just looking at kind of in the upper left, kind of charting out the impact that we saw on treasury rates based on maturity, what you would expect to see with a decline in interest rates is what played out. Shorter term debt, was more modest. Longer term debt, where it's more interest rate sensitive, had the best performance during the quarter, with the whole shift in the yield curve lower, with the Fed cutting rates and people kind of flooding to quality. On the credit side, similar play where high quality debt did well on a relative basis. High yield debt and lower quality high yield debt did more poorly. And some of those numbers are impacted not just by credit market functioning, but also there's some sector aspects to that, where certain energy stocks are heavy issuers of high yield debt. You may have some airlines, other industries that were impacted there. But what we saw generally is decline in interest rates pushed up bonds generally, but credit spreads widened pretty significantly during the quarter. So the impact that has for bond investors kind of depends on the type of bond fund that you're invested in. If you're investing in corporate or core bonds, similar to the aggregate bond index, returns were modest, generally slightly positive. But what we typically see is most active fixed income managers are investing in core plus strategies. That the plus is those sectors that didn't perform as well: high yield, international emerging markets, some floating rate debt. And so as we start to kind of look at first quarter returns for client reports, it's one thing that we're seeing, pretty consistently across the board is that those core plus strategies that many plans are using, or active core fixed incomes, are underperforming benchmarks because they tend to fund the allocation to those plus sectors by a lower than benchmark allocation to treasuries. And generally over the long term, that has worked well for many managers, but in times of extreme financial crisis like we've seen, it has caused some underperformance relative to the benchmark for fixed income managers.
So on the equity side, Eric used terms like unprecedented, uncertain, extreme, all terms that give financial market participants extreme anxiety. Stocks similar to fixed income, are really looking for predictability, and when you introduce uncertainty and unpredictability, you get extreme reactions, and we saw that here in the first quarter. On the left-hand side here, you see returns by sector for the S&P 500. And the S&P 500 overall was down nearly 20% for the quarter, which is the worst performing quarter since the financial crisis in 2008. All sectors were down, led by energy and finance. The energy sector was hit by the double whammy of not only COVID impact on oil prices, but also the Saudi Russia price war on oil that saw over a 60% decline in oil, with price per barrel ending up just around hitting a low of around $20.50, which is an 18-year low for oil. What we saw during the quarter was growth outperforming value. That's a theme you've heard for the last 10 years. And then also, large cap outperforming small cap in the U.S.
David, one comment I would add, and maybe I guess you're going to get to it when you talk drawdown. I think, as people start to look at quarter end numbers, the S&P down 18-19% actually seems, if you've been following it kind of day to day, pretty good, because the drawdown we saw intra-quarter was actually much worse than that.
Right. And on this slide, what we show you is the drawdown. And to Scott's point, what you can't see is that it actually bounces back up. What this slide is intended to do is to show you peak to trough performance. So you see that we had, this isn't the first time we've experienced a significant decline, but it is different than the tech bubble and post 9/11 environment in the early 2000s, and as well as the global financial crisis. Both of those were ultimately larger drawdowns, but they happened over a longer period of time. I think that's what's been the most challenging, or one of the more challenging pieces of this equity market, is the speed in which the demand side has fallen off. And the impact that investors have had, and the speed at which they've responded to the crisis and the sell-off on equities. So, to Scott's point, we were down in the 30% range just before quarter end, and there was a bounce back, and we've had a subsequent bounce back here in April as more news comes around the fight against COVID, and the investors making bets on either side of what the ultimate impact and when we're able to come back to quote unquote normal in equity and our economic environment. I think the piece here on the next page talking about the VIX, or sometimes refer this Volatility Index, or the VIX, we sometimes call the fear index, and it's really a way to measure the expected volatility going forward on the S&P 500. So it's a proxy for expected stock volatility over a relatively short period. What we see here is, obviously a rapid spike in expectations of volatility as we moved into February and March. We've come off of those peaks, but we're still, I think the latest figure I saw is we're still about 2.5 times the expected volatility as what we saw at the year-end value. So we're still, investors are still expecting volatility moving forward. Although we've come off of the peak, it's still twice as high. And I think one of the interesting things we've seen here in April is if it's 6 out of 7 or 7 out of 9 trading days in the month have been greater than 1.5% moves. So it's definitely a time for steady ship, steadying the nerves. This page, when we talk about valuations, we use a common measure of relative value, and it's price to earnings. So the price of a stock relative to the earnings of a share of that stock. So another way of saying it is, right now on a historic basis, you would spend about $20 for every dollar of expected earnings or of trailing earnings. So this is looking at trailing earnings. You could look at forward earnings, but either are views of value. What you see here is that stocks going into this were expensive relative to historic averages, and as we've seen a decline in the P of this equation, so the prices come down, you would say that, well, stocks have become cheaper. The concern that many investors are expressing is, well, the P has come down, but what's happened to the E? What's happened to the earnings? As we've shut down the economy to slow the spread of COVID, that's certainly going to have an impact on companies' earnings going forward. And so as prices come down, so has potentially earnings. You may see a spike in the price to earnings ratio, which means stocks were expensive on a relative basis, historic basis going into it. They may be still, they may not have become cheaper on a relative basis as we move into earnings season, which started this morning with a couple of large financial institutions providing earnings reports. The other piece on this that I think is important is companies, when they give earnings reports, usually provide or expected to provide guidance over the near term as to their expectations of what earnings will be for the coming year or quarters. And with COVID, what we've seen is a spike in the lack of guidance or the retraction of guidance by companies as they're experiencing uncertainty about what their financial prospects are for the near term. Outside of the U.S., certainly no haven of safety. As what happens typically in these times of crisis, correlations rise, and risk assets, whether they be in the U.S. or outside of the U.S., tend to move more in lockstep. We saw, from a broad standpoint, down in the bottom right-hand side, you can see whether it was developed and emerging. It was really all regions experienced a significant sell-off, which was also furthered by kind of the flight to quality from a currency standpoint, as investors sought the safe haven of U.S. dollars. So the currency impact also negatively impacts the return. So non-U.S. equities off around 22% or so for 23% for the quarter. So U.S. stocks outperformed non-U.S. stocks, developed outperformed emerging. So that flight to the quality or that risk-off environment certainly was there. On this slide, the global asset class return, the risk-off environment, bonds certainly outperformed equities. That's your dark line at the top that shows a little bit of an uptick during the first quarter as investors sought safety some of the very high quality issuers, primarily in that index, the U.S. government. But then as you go down, you start to see U.S. large cap equities, and then a mix of non-U.S. equities, and then finally small cap equities there at the bottom. So what's perceived to be the higher risk assets decline more as you went through the quarter.
It's one of the things that is true coming out of 2008, 2009, where a lot of target date funds, which have become obviously a larger and larger portion of qualified retirement plan assets, there was a lot of stress testing done in 2008, 2009. A lot of firms that had attempted to try and generate returns through credit spreads, taking interest rate bets, more highly volatile asset classes, commodity structures, largely revisited those structures. So this has been the first opportunity really since 2008, 2009 to retest some of those structures. And I think the good news is, at least as you measure it by the S&P target date indices, pardon me, that ultimately, the returns even for those particular investments has not been as negative, I think, as many would expect. As David just showed you, target date, or the S&P, was off 22.5%, small cap index was off 34%. You're looking at target date returns, you're seeing much better performance on a year-to-date basis. So those that are in retirement on average off 8%, maybe 12%. Obviously, younger investors with heavy asset allocations to equities are going to be off, but they're off 23 to 24%, largely in line with where the S&P was, and adding some international exposure. I do think that what happened to some target date products over the course of the market rally from 2009 through, frankly, January of 2020, was we continued to see more target date funds increase their equity allocation, essentially jump on the bandwagon of a rising stock market. And I do think that some of those more aggressive glide paths are going to experience returns that are not as attractive as the indices you look at here. So those managers that did increase or always had very large equity allocations aren't going to exhibit the same downside protection. But I think it is good news that by and large, at least as we look at target date positions held by our clients, that ultimately the returns appear to be much more attractive than what we experienced at the bottom of the 2008, 2009 period. So with that, I think that brings us to the close of our 30 minutes. Again, we appreciate everyone's time. We want to let those of you go that may have other issues to get to, but we'll leave it open for a few minutes to take any questions that you might have on what's happening from what has happening and has happened from a market perspective.
Eric, will you, I guess, get any questions there? I guess a couple comments I would have on target date performance. One, you mentioned the increasing equity glide paths. I think if we looked at not the index, but looked at actual fund performance, what we see is the dispersion of returns for those investors farthest from retirement, the 2050s, the 2060 funds, is relatively narrow. And where we're going to expect to see probably the greatest variance is those funds that are nearing retirement, where your equity allocation, if you're 60% stock near retirement or 30% stock, obviously will have a greater impact on the variance of return. So I think we spend all the time we have when we talk to investors talking about the diversified portfolio and the benefits of that, and that not being the market. I think it's a good reminder of the importance of understanding the glide path and the target date funds that you have in your portfolio, because for the series that we've looked at, they've performed generally in line with our expectations. We have some clients that have more equity-oriented glide paths, and those have done worse. Clients that have been more defensive, for the past couple of years, those funds have lagged, but they have held up better now, and its greatest impact is on those people nearest retirement.
Yeah, I think the dispersion, Scott, you can comment, or David, but I think on the retirement income products, you're looking at equity allocations that are traditionally somewhere between 20 and 50% of assets, which is obviously a huge driver of risk in a market like the one we have right now. Well, we must have done an exceptional job. No questions. Everyone feels at this point entirely certain with the direction of the market going forward. In the next webinar that starts right after this, we'll tell you where the market's going tomorrow. We didn't send out a link for registration. It's more of a secret webinar that we haven't yet publicized. But no, I want to, again, thank everybody for participating. I know it's a tremendously stressful time with a lot of changes in regulation. For those on the finance side, a lot of rebudgeting that's being conducted, obviously, within organizations on the human resource side, addressing the needs of participants, employees, and in these very highly uncertain times from both a health perspective and a financial perspective. So we appreciate you taking a few minutes. If you do have questions that occur to you after this, obviously feel free to reach out to any of the three of us or any of the other consultants at Multnomah Group. We'd be happy to address those questions offline. Thanks for your time, and we hope you have a great day.